Hello, my name is Fatiha Amira binti Fadl Azmi, and I hope you are doing well and great. Today, our group will be presenting regarding Module 2, which is the topics of presentations of financial statements. I'm the first presenter. Will talk about subtopic regarding the complete sets of financial statements. First of all, I'm gonna cover the basic journals of financial statements that governed by standard IAS 1. Alright, IAS 1. This standard was ever created for helpers to go through and give a guidance on what the financial statement should look like, because we have one set of financial statements that covers everything that the users of accounts need. So remember that we have a different users of the accounts, whether that's the shareholder, the employee, the lenders, or the government. They all use different things from a set of accounts, open them in terms of looking the performance that the positions may be specific to do with the performance or all the positions. There is a 5 elements for all of it, as you can see at the slides. First is statements of financial position, statements of profit or loss and other comprehensive income, statements of changes in equity, statements of cash flow, and the notes to the accounts. Okay, for the statements of financial position, also known as a balance sheet that represents the assets, liability, and equity at point in time, while statements of profits or loss and other comprehensive income shows that an entity's financial performance in a way that is useful to a wide range of users, so that they may attempt to assess the future net cash inflows of an entity. As for statement changes in equity, that shows all the changes in equity for a period of time, that it reflects all the changes in equity between the beginnings and the end of the accounting period arising from transaction such as a new capital investment, the dividend paid, and others. While for the cash flow is a financial statement that summarize the amounts of cash and cash equivalents entering and leaving a company. It measures how well a company manage its cash positions. And lastly, the last element is notes to the accounts. So the accounts tell us about such as how we measures our inventory, either using LIFO or FIFO methodology, and some explanations about accounting policies and so on. The most important in the financial statements is financial statements should provide a fair presentations of the results, which is achieved by a compliance with IFRS. Last but not least, additionals, the entity should also disclose the following to make the financial statements more understandable. So for the first, like the names of reporting entity, whether the financial statements are the individuals or a group financial statements, the reporting dates and the period covered by the financial statements, the presentation currency, and the levels of funding used in presenting the amount within the financial statement. So that is for my part, and I will pass to the next presenter. Thank you.
Hello everyone, I am Nurul Shaira binti Asni Suhaimi, and today I am going to discuss point 2.2 accounting policies in module 2 presentation of financial statement. The flow of my presentation today, I would like to discuss firstly selection of accounting policies, number 2 consistency of accounting policies, number 3 disclosure of accounting policies, and last but not least, the changes of accounting policies. In selection of accounting policies, IASA defines accounting principle as a specific principle-based rules and practice applied by entity in preparing and presenting the financial statement. So, what are the examples of accounting policies? Firstly, it is method of reduction. Either we want to use depreciation or amortization. Number 2, it is valuation of fixed asset. It's either we want to value our fixed asset through historical value or the fair value. IASA requires management to select and apply accounting policies using hierarchy. What is meant by hierarchy here? Firstly, when IFRS already specifically applies to the transaction, the accounting policies must follow by the IFRS apply. But when IFRS do not apply to the transaction, IASA requires management to use professional judgment, develop and apply the accounting policies that is relevant to the economic decision making. Moving on to the consistency of accounting policies. It has two ways. By doing consistency, it allows user to compare financial statement of entity over time. Number 2, it also helps to identify trends in financial position, performance, and also the cash flow. IASA already require entity must apply its accounting policies consistently for similar transaction, unless an IFRS already specifically requires them or allow a categorization of item of 4 different accounting policies to be used in the accounting standard. Moving on to the disclosure of accounting policies, IAS 1 requires the entity to disclose its accounting policies comprises of number 1, the measurement of basis used in financial statement. Number 2, the other accounting policies used that are relevant. Last but not least, changes in accounting policies. IAS 8 permits an entity to change its accounting policies only if it is required by FRS itself or it is result in financial statement providing more reliable and more relevant information. This point here meaning to say the entity is voluntarily change the accounting policies. But there is one we need to note here. When accounting policy change due to new IFRS, transitional provision applied. Transitional provision here meaning to say there is a transition gap to apply the new IFRS. It is not instantly need to apply it. There is condition where it is not a changes in accounting policies. IAS 8 already clarifies two conditions. Firstly, the application of the accounting policy for the transaction different in substance from previously occurred. This means it is never occurred before. This is the first time. If that is the first accounting policies were introduced, it is not considered as changes in accounting policy. Secondly, the application of new accounting policies for transaction that is not occurred previously or material. When there is no transition provision in IFRS or entity voluntary change in accounting policy, the accounting policy might be changed retrospectively. Retrospective application for voluntary changes in accounting policies help to ensure prior periods are comparable to current period of financial statement, but in some cases it is impracticable to adjust more than one prior year period due to data no longer available and not to be collected as in the year before. Moving on, when an entity changes in accounting policy, it must make several disclosures as follows. But when an entity makes a voluntary change in accounting policies that influence current year or prior year period, entity must also disclose as follows: nature, reasons, amount of adjustment, and so on and so forth. That's all for me. Thank you.
Okay, hi. My name is Khairul Anwar bin Ibrahim. Okay, today I will tell you about the accounting estimates and correction of errors. Okay. In this topic, there will be two subtopics, which is change in accounting estimate and material errors in prior period. Okay. What is change in accounting estimate? Okay. A change that has the effect of adjusting the carrying amount of an existing asset of or liability or altering the subsequent accounting for existing or future assets or liabilities. Okay. There are necessary consequences of management periodic assessment of information used in the preparing of its financial statement. Okay. For the third point is the change in accounting estimated could give a big impact, which is it can create the new information for the organization. For the example is useful of lives of property and equipment. The second example is estimates of uncollectible receivables. The third one is obsolete inventory, and the last one is warranty obligation. Okay, for the disclosures, for the change is first you need to disclose the nature and reason why. Okay. The second one is the method that we use to change it. The third one is if it is stated, the disclosure are stated in this period. Okay. So it is not required to disclose the same feature for the subsequent period. And lastly is impact of financial statement lines item. For example, is earning per share and income of it. Okay. Okay, the next one is material errors in prior period. Okay, what is the meaning? Okay. Prior period errors are omissions from and misstatements in an entity's financial statements for one or more prior periods arising from a failure to use or misuse of reliable information that was available and could reasonably be expected to have been obtained and taken into account in preparing those statements. Okay. For example is first, mathematical mistakes. Second, mistakes in applying accounting policies. The third one is oversights or misinterpretation of facts. Lastly is fraud. Okay, for the disclosure. Okay. First, we need to mention the nature of the prior period error. Second one is the amount of the corrections at the beginning of the earliest period presented. Okay. The last one is if his perspective his statement is impeccable. Hence, we need to give the explanation and the descriptions of the areas how we solve it. That's all for me. Thank you.
Hello, my name is Muhammad Wal Ikram bin Cik Ismail. I'm from Model 2 Group. Today I will talk about the IS10 event after the reporting period. Okay, before we go further, you must understand this timeline first. So there are two dates in this timeline, which is first one is reporting date, I put 31st December, and the second one is authorization date, I put 31st March. So the duration between these two dates are normally 3 months. So the IAS 10 only apply between these two dates. The event that occur after this date, which means that after 31st March, IAS 10 does not apply. So there are two types of event after the reporting period. The first one is adjustable event. The second one is non-adjustable event. Adjustable event means refer to those that provide additional evidence of condition that existed at the end of the reporting period. Means that we have additional evidence that occur before the reporting period, means that before the 31st December. Second one is non-adjustable event, which means that those not in existence at the end of the reporting period but which arose for the first time after the end of the period, means that we don't have any evidence that occur before 31st December. Okay, so now we go to the example of adjustable event. So I put for example of the adjustable event here. So the first one is court case that was existent but not settled by the end of the reporting period is now settled. That was existent means that existent before the reporting period but not settled by the end. Not settled by the end of the reporting period. In this case, we put 31st December. So maybe these court cases are settled in January or February. So this is example of the adjustable event. So next is profit share and bonus payment if obliged to make this payment before the reporting period. So means before the reporting. So we have the also the additional evidence before the reporting date. So an asset value for inventory that was estimated is now known. So this affecting the net realizable value. So that's why it has the existing evidence before the reporting period. And the last one, if fraud and error discovered after the reporting period show the statement were incorrect. So we do error before the reporting period and then we discover it after the reporting period, so we need to adjust. So this is one example of the adjustable event. Okay, next we go to the example of non-adjustable event. The first one is a plan to shut down of a business after the reporting period. Second, decline in market value of investment and destruction of equipment by a fire. Major business combination changes in tax rate announced after the reporting. Yeah, so if you see all non-adjustable event occur after the reporting period, means that all the information or all this event does not relate to a condition that existed at the end of the reporting period. Okay, now we go to the treatment of event after reporting period. There are three treatments. First is adjust, second is disclose, and third one is do nothing. So to know the correct treatment of subsequent event, there are some questions to consider to determine it. The first question is that it's affect an existing event or condition. So if the answer is yes, we must adjust it in PL or balance sheet or OCI. So if the answer is no, we must ask additional question. The question is it material? So if the event are material, so we need to disclose it in the note of the financial statement. So if the event are not material, we don't have to do anything. Do nothing. Okay, that's all from me. Thank you.
My name is Jonathan and this is Financial Reporting Module 2 Presentation of Financial Statement Part B Statement of Profit or Loss and Other Comprehensive Income. So, the key indicator of a business entity financial performance is its report profit or loss figure. Therefore, how profit is determined and the information that is disclosed concerning the determination of profit or loss are central accounting issue. IAS 1 deals with the matter or more expensive notion of financial performance is comprehensive income, which equal the profits or loss added together with other comprehensive income for the period. Part B discussed the composition of statement of profit and loss and OCI, including what is required to be included in the profit or loss and what is included in other comprehensive income. Under IAS 1, an entity has the choice of presenting either a single statement of profit or loss and other comprehensive income or two statements. For example, a statement of profit and loss and a statement of comprehensive income. So, the figure here shows that IAS 1 requires an entity to prepare and include a statement of profit and loss and other comprehensive income for the period in its complete set of financial statement. So if you see the graph, the figure, the brown one, which states a single statement of profit or loss and other comprehensive income with two sections presented together. First section for the profit or loss followed by the second section for other comprehensive income, or two statement. The two statement, a separated statement of profit or loss presenting component of profit or loss which must be immediately followed by a separate statement presenting comprehensive income, beginning with the profit or loss and presenting component of other comprehensive income. IAS 1 allows an entity to use other titles for the statements. For example, the statement of profit and loss can instead have the title income statement. Similarly, an entity can use the term and net income to describe the profit or loss. So the concept of other comprehensive income and total comprehensive income. So in this we see that IAS 1 states that the component of other comprehensive income include gain and losses in the revaluation surplus resulting from the revaluation of property, plant and equipment under IAS 16 or intangible asset under IAS 38. Gain and losses from remeasurement or defined benefit plan under IAS 19 and gain and loss arising from translating the financial statement of a foreign operation under IAS 21. Gain and losses from investment in equity designated a fair value through OCI under IFRS 9. And lastly, gain and losses on other financial assets measured at fair value through OCI under IFRS 9. These are some of the example of the concept or the component of comprehensive income. So we are at disclosure and classification. So here IAS 1 allows entities in choice in presenting either a single statement or a two statement, as we seen before in the previous slide. So a single statement of profit and loss or other comprehensive income, or two statements, separate income statement and a statement of profit or loss and other comprehensive income. IAS 1 also contains disclosure and classification requirement for statement of profit or loss and other comprehensive income. information to be presented in the statement of profit or loss and other comprehensive income, presentation and disclosure, separate disclosure of income and expenses items. And lastly, classification of income and expenses. These are what contains in a disclosure and classification requirements. Information to be presented, other comprehensive income, presentation and disclosure, separate disclosure of income and expense item, classification of income and expenses. So last, the relationship between statement of profit or loss and other comprehensive income and statement of changes in equity. As net profit after income tax are transferred to the retained earning column in the statement of changes in equity. Items included in other comprehensive income (OCI) are transferred to the reserve column in the statement of changes in equity. For example, if there was a revaluation of an asset, this would be transferred to the reserve column in the statement of changes in equity and end up in revaluation surplus. Similarly, any foreign exchange gain or loss arising in respect of foreign operation would be transferred to the reserve column in the statement of changes in equity and end up in foreign currency translation reserve as per IAS 21. That's all for me. Thank you.
My name is Lokadevan Devaraj, and today I'll be presenting on tips on how to analyze statement of profit and loss and other comprehensive income. And also I'll be presenting on statement of changes in equity from module 2. So the first step is reviewing the components of income. You must see whether the company or the entity has increased or decreased their income comparing to their previous reporting period and what caused that. The same explanation goes to the second point. You must see whether they increase or decrease their expenses and how they classify the expenses. The third one will be the profit. You must see whether the entity had made profit or loss comparing to the previous reporting period. The fourth one will be reviewing the OCI result, which is you must see whether their OCI had made any significant changes, for example, asset evaluation. The fifth one will be overall performance. You must see the overall performance of the company, and you must give your own opinion on how they performed, whether they performed better or worse than the previous reporting period. Next, we will move on to part C, which is statement of equity, changes in equity. In addition, in a statement of profit and loss and other comprehensive income, IAS 1 requires to include a statement of changes in equity which discloses the changes to each entity item arising from comprehensive income, transactions with owners, and retrospective adjustments in accordance with IAS 8. A reconciliation between opening and closing amounts of each component of equity for the period. So that's what you need to disclose in statement of changes in equity. So this is the components or the items can be found in statement of changes in equity. So there will be 4 items, which is share capital, reserves, retained earnings, and total of all of it. So the first item will be share capital. For this, you must have the opening balance, and you must plus with issue of share capital, and plus with share options exercised, and minus the share buybacks or return of capital. You get the closing balance. The second component will be the reserve. First, starting with opening balance, plus transfers to reserves from retained earnings, minus transfer from reserves to retained earnings, either plus or minus. And then you must also plus or minus gains or losses on property of revaluation, and also plus or minus exchange differences on translating foreign operations. Closing balance. The third component will be retained earnings. Start with opening balance, plus or minus net profit or loss after income tax from income statement, and either minus or plus the transfers to reserve from retained earnings, either minus or plus restatement of prior period balances, whether due to a change in accounting policy, adoption of new accounting standard, or prior period material error. And also minus dividends declared and the closing balance. And the last row or column would be your closing balance total. So that's all from me. Thank you.
Hi everyone, my name is Muhammad Rizwan bin Hashim. Today I'm going to present to you Module 2, Part D, which is Statement of Financial Position. So, first and foremost, the format of the Statement of Financial Position. So here's the disclosure of the item that to be stated in the SOFP. Minimum line item required in the statement. So we have asset, liability, and equity. So under asset, we have PPE, which is plant, property, and equipment, investment property, intangible asset, financial asset, and inventory. Under liability, we have trade and other payable, provision, current tax payable, and deferred tax liability. So under equity, we have non-controlling interest and issue capital and reserve. So that is presentation of asset and liability. So how can we determine current asset and current liability? So here's the criteria. Under current asset, it expects to realize the asset or intend to sell or consume it. And then the assets are primarily for trading purpose. So under IAS 7, the assets are cash or cash equivalent. And how can we determine current liabilities? So it expects to settle the liabilities in the entity's normal operating cycle. And it holds liability primarily for trading purpose. And liability need to be settled within 12 months. And lastly, it does not have an unconditional right. So, if the asset or liability does not satisfy the criteria, so as the current, so they must be classified as non-current asset or non-current liabilities. And lastly, the disclosure of the item. It is depend on the size, nature, and function of the amount involved. So, for example, under IAS 16, we have PPE, plant, property, and investment. Plant, property, and equipment. So, we need to classify PPE as office equipment and motor vehicle. For receivable, we need to classify them as a trade customer and prepayment. Under inventory, we need to classify them as finished good, work in progress, and raw material. Under IAS 2 provision, we need to classify them as employee benefit and other provision. For equity capital, we need to classify them as paid-up capital and related earning. That's all for me. Thank you.
Hi, I'm Nurul Nasuha. So now let's moving on to IAS 7, which is statements of cash flow. So first thing first is cash and cash equivalents. Cash is resources that immediately available to pay obligations, and for cash equivalents, it is short-term, highly liquid investments and also readily converted into cash with little or no risk of loss. For example, over here, certificate of deposit, and another example also is treasury bills. And the maturity date must not be longer than 3 months or 90 days or less from date of purchase. So cash flow statement is actually a report that shows us when cash entering the business and when cash leaving the business. And if it shows positive figure, it means that the cash entered the business. And if it shows negative figure, it means that the cash leaving the business. So what's the purpose of cash flow statements? So over here, it explains for the changes in cash, because from cash flow statements, we will know where the money goes out and where the money coming from. And it also tells us the information about non-cash investing, for example, the purchase of plant, property and equipment, and also financing activities, for example, borrowing from the bank. And the cash flow also tell us the financial condition of the firm, provides a view of management strategy, and also it is a part of legal requirements. So cash flow statements consist of operation, financing, and investing activities. And for operation, this is the most important part because it shows us how much the cash is generated with the actual operation of the business. And it means that by selling the company's product and services, which is the cash from core business. And then we have financing activities, which is this section summarizes cash transaction that involves raising, borrowing, and repaying capital. And we can see here, okay, the company issued new shares and dividend were paid and loan was taken out. And the last one, cash flow from investing activities, which is this either cash spent on investments or cash received from sales of investments. And in other words, it's outside of primary business activities of selling products and services. And in this section, we can see, for example, the company purchased assets like machines and equipment, or maybe even acquire another business over here. And last but not least, at the bottom of these statements, okay, we can see reconciliation of balance sheet, and it shows the starting of the cash from the last period and the ending balance from the current balance sheet. So, and that's all from me. Thank you. So now I'm passing to Shira for IS7 Part 2.
Hi, my name is Izian Inshira. Today I would like to present Module 2 about how to apply and analyze statement of cash flow. So let's go. There are three common methods used to prepare statement of cash flow, which is worksheet method, formula method, and T-account reconstruction method. So, formula method is a brief summary of the formula necessary to determine individual lines in the statement of cash flow. Once again, it needs to be remembered that the figures in the financial statement are prepared under accrual accounting principle, while the statement of cash flow is based on cash movement during the reporting period. So, this is 7 common formulas used to determine cash flow, which is receipt from customer comes from opening balance trade receivable plus sales revenue minus bad debt written off minus closing balance trade receivable. So bad debt written off comes from opening balance allowance for doubtful debt plus doubtful debt expenses from profit and loss minus closing balance allowance for doubtful debt. For inventory purchase on credit comes from closing balance inventory plus cost of goods in profit and loss minus opening balance inventory. And for payment to supplier and employees, opening balance trade receivable plus expenses in profit and loss plus inventory purchase on credit minus closing balance trade payable. And for income tax paid comes from opening balance tax payable plus income tax expenses from profit and loss minus closing balance tax payable. And next, for purchase of PPE comes from closing balance PPE plus disposal at cost minus opening balance PPE. And the last one is dividend paid. Dividend paid comes from opening balance final dividend payables, which is liability, plus interim dividend plus final dividend minus closing balance of final dividend payables liability. Okay, there are 5 steps to analyze statement of cash flow. First is you need to review the cash balance at the end of the reporting period. Either the value is positive or is less, or is it less than the balance at the beginning of the reporting period. Second is you need to review the cash flow from operating activities. So this figure is essentially the entity cash profit. So a positive value is a good sign that the entity has made a cash flow the reporting period. If the result for the current period is higher, so this is a good sign as it indicates the entity cash profit has increased. As a general rule of thumb, the entity should report a positive cash flow from operating expenses, and this amount should, in principle, be enough to cover net cash used in investing and financing activities. The third one is you need to review the cash flow from investing activities. Either the value is positive or negative. If negative, this indicates that the entity has invested in non-current assets. This could mean that the entity is expanding its operations or that the entity may be in the startup or growth phase of the business life cycle. So the fourth one is review the cash flow from financing activities, which is review the increase or decrease in external borrowing, review the increase and decrease in equity, has the entity paid dividends or issue more share to raise capital, and how does the payout of dividends compare to the net cash flow from operating activities. And the last step is review the net increase or decrease in cash and cash equivalents. So a positive value indicates that the entity has retained funds for a reporting period. This also indicates that the entity has generated substantial cash profit from operating activities. This will be particularly pleasing for shareholders who are interested in the ability of their investment to generate positive return. So that's all for me. So thank you.